Hello, my name is Doug Schaefer, and I am the Director of Client Strategy for EnerNova Partners. And I just want to welcome you to the February market update call. What I'm going to do on the call today is just go over the basic fundamentals that are impacting the natural gas market, talk about each one, talk about whether it's a bullish causing prices to go up or maybe a bearish indicator causing prices to stay flat or go down. So the first thing we wanted to talk about today was the weather. The weather this winter, as most people have realized, has been very mild. This has put a lot of downward pressure on the market, and the mild temperatures are expected to continue. I think over the next couple days, we might see a little bit of a return to normal temperatures, but starting mid-February, we start to see above normal temperatures start to show up again in the central US. And as we go out a little bit further, those temperatures, those above normal temps, start to grow more across the US as we go. One of the other things that we're looking at weather-wise is the current, sorry, wrong slide, but is the current weather outlook for the upcoming months and even this summer. This summer is the next somewhat, I'll say, big weather event that the market's going to watch and see. Is it going to be really hot where we see high demand, we start burning a lot of natural gas, or does it stay on the cooler side? At least what we're seeing right now from NOAA, they're calling for these above normal temperatures to continue essentially through the fall and even early winter. So we'll see how that plays out. The one thing that we are starting to notice is that we are potentially going from a current El Nino situation to, the market came out the other day and said we're on a La Nina watch, which could change these weather patterns. If we do switch to a La Nina pattern, it typically leads to more drought conditions in the Southwest, which can lead to more heat across the entire U.S. One of the other fundamentals that we look at is natural gas storage. Natural gas storage, the reason that that's important is that in the winter months, we don't produce enough natural gas to meet the daily demand. And so we need to pull natural gas from storage in order to meet that demand. And in the summer, we're injecting natural gas into storage. So where the levels are at compared to last year at this time and to the 5-year average has a big impact on the market. And we're seeing basically from last year, we're seeing a reversal. You can see at the early part of this chart in 22, we were well below, the 5-year average. We were almost outside of the average 5-year range. That switched last year as we came out of a mild winter and has continued all the way through this winter. And you can see that we are trending above normal. We are roughly 187 BCF more natural gas in the ground than what we had last year, and we're 248 above the 5-year average. This current glut that we're seeing in storage, barring any major events, is expected to take, potentially 12 months or longer to kind of work its way out. So as we continue to see those strong volumes in storage, it's definitely going to help keep the market in check. The next item that I wanted to talk about was natural gas production. You can see over the last 5 years, we've enjoyed, almost a steady growth trend, pointed out by the white and the yellow, or I'm sorry, the white and the red arrows. The one thing that we're starting to see is a flattening off of that production. The EIA is estimated for us to stay in that 103 to 105 range that we're currently in through the balance of this year. So depending, again, what demand does and what the summer is going to look like as far as heat, will have a big impact on those storage levels, how much natural gas we're producing, and how that all plays out in the supply and the demand mix. One of the other things we look at as far as natural gas production is the number of rigs that are out actively searching for new sources of oil and natural gas. And you can see that basically since November of 2022, the rig counts have gone down 161 rigs. This hasn't shown up yet in the production. We still have seen that growth and even the flatter production. But a lot of people are expecting we could start to see production tail off a little bit, mostly due to the low prices. If you're a producer, you're not going out and spending a lot of money to drill new wells when the natural gas markets are in a $2 range. So one of the other things we look at is natural gas demand, the other side of the supply and demand mix. And we are right now, running lower than what we typically see at this time of year. However, we did back in middle of January, we actually hit an all-time high, for record demand. So it kind of shows that the market still has that potential. There are still events that could lead to extremely high demand. The issue and the main driver behind that demand a lot of times is weather. In the winter, if it's extremely cold, like we saw in the middle of January, you can have that large spike in natural gas. And the issue, what can happen is if that colder temps are sustained, if this would have lasted, a week, more than just a day or two, we would have seen probably a pretty big run up in the natural gas markets, which would have then carried over to the power markets. But overall, with the mild weather, the mild temperatures, it's keeping a lid on demand and putting us again, in a good spot that's helping push prices lower, especially in the near term. One of the other factors in demand is LNG growth. LNG is liquefied natural gas. It's natural gas that is brought to facilities and they cool it to roughly negative 260 degrees and the gas becomes a liquid. And then they can put it into ships and ship it around the world. We are the largest exporter of LNG in the world. A lot of that natural gas is going over to Europe since they really don't have Russian natural gas anymore, and then also to the Asian markets as well. And one of the things that we've seen is you can see the steady growth in LNG. And in fact, LNG exports over the last 5 years have increased by 238%. And they're expected to continue to grow. We're expected to see the growth go from about 14 and a half BCF up to over 26 BCF per day by the end of 2027. So we're going to see roughly another 90% increase in LNG exports, over the next 3 years. And another way to kind of look at it is here you can see the growth, the current approximately 14 BCF a day that leaves the country. We're going to add roughly another 5.5 BCF this year, an additional 3 BCF over 25 and 26, and then another 4 BCF by the end of 2027. And, the market is kind of watching too. The Biden administration a few weeks ago put a pause on approvals for new LNG facilities in the U.S. I believe the House is voting on Friday whether they will allow that or not. But essentially what that is doing, it's putting potentially a pause on this gray area, an additional 14.7 BCF per day that could come online after 2028. So you can see if this growth continues, we're going to need production to grow to keep up with that new demand because it's going to be a significant part of the natural gas that we produce will be exported around the globe. So all of the different aspects, all those different fundamentals, what have they done, to the market? And you can see this is a chart for the 12-month strip of natural gas. And you can see towards the right side here, the dip, when we started to have a lot of natural gas in storage, it put a lot of downward pressure on the market. The colder weather kind of came in, the market ran up. But then the mild temperatures for this winter have kind of taken hold, and the market has been in a steady decline ever since. What I like to do on these charts is kind of show the white line is current price. The green line is kind of based on the chart. That's the low that we've seen over roughly the last 5 years. Has been way back in March of 2020. So we're back at prices before all the craziness, with Russia invading Ukraine and the different energy issues that have gone on in the world over the last year or so, 2 years. And the red line kind of represents where that high was. And this kind of, as a consumer, gives you a kind of that risk reward scenario. You could look at this current price and say, well, I don't want to buy anything right now because I'm hoping the market will go a little bit lower. But on the other hand, there could be some unforeseen event that could happen in the marketplace that could potentially cause prices to go back up over $8 for that 12-month strip. So this just kind of lays out, if you're looking on whether should I do a 1-year purchase, a 2-year purchase, it kind of gives you a good feeling for what is the risk I'm taking on if I wait? What is the reward if I wait? So the next chart I just want to show you is again, basically the same chart, but this is the 24-month strip. And you can see the current price, from the low over the last 5 years. There's a little bit more of a gap, so a little more potential for savings, but also you can still see that there's still a significant amount of risk in this market. And by taking another look at it, these are the current calendar years for NYMEX Henry Hub. And if you look at Cal 25, 26, 27, and 28, you can see Cal 25 again. Now this is looking at a shorter period. This is roughly over the last 2 years. So over the last 2 years, you're very close. That risk or that reward level is somewhat very small. And you can see the risk level is rather large. And then as you kind of see the same for 26, 27, and 28. And when you see that gap between 25 and those outer years, this gives you a chance to kind of pause and to kind of look at all the factors and say, where could this thing go? And the nice thing about different strategies in buying electricity and buying natural gas is you don't necessarily have to do it all at one time. If you wanted to do a one-time purchase fixed price, you could do a shorter term versus a longer term and watch those outer years. Or you could do a layered approach where maybe you go out right now and you said, okay, I want to buy 100% of my 2025 natural gas, but for 26, 27, and 28, I might only want to buy 25 or 50%. That's what we can kind of do at EnerNova Partners, is sit down with you, lay out these fundamentals, what they mean in the marketplace, and help you to develop a strategy that fits your risk profile for your company. So the last two charts I just want to jump into is on the electricity side. The first one being PJM West Hub on peak, which is more reflective of Pennsylvania, New Jersey, Ohio, Maryland pricing. Again, I kind of laid out that risk reward strategy. And again, you see there's that premium, in the outer years right now. A lot of that is some fundamental changes that are currently going on in PJM. And another part of it is just the typical risk premium. Because of everything that has occurred over the last 2 years, there's a lot of risk for sellers to maybe sell all of it at a much lower price. They're holding off and they're waiting to see how the market plays out over time. And the final chart just gives us a look at the ERCOT North Load Zone, which is the Dallas area for most part. This chart, you can see it's a lot different, a much bigger gap kind of on the reward side. Not as much of a space between that upper risk level. That's not to say we won't get there or we won't go beyond that based on current fundamental aspects to Texas. There's a declining reserve margin, which puts a lot of pressure on the grid during the summer months. There's a lot of new demand growth coming, whether from data centers, Bitcoin mining. There's a lot of factors that are kind of coming into play. And, these markets are almost doing a reset from the extremely low prices from 3+ years ago to the market, just the craziness in the markets during the initial um, Russia invasion of Ukraine. So all of these things, high inflation, just high cost of everything, is really causing the markets to adjust, and it's going to take some time, for these things to work out. And over that time frame, the market's going to adjust. It could potentially adjust a little bit higher, or lower, but time will tell. I wish I could sit here and give you 100% certainty on what the market's going to do. But we all know that that's kind of impossible to predict. But what we can do and what we do for our customers is lay out the risk reward strategies so that they can budget to what's going on in the market and hopefully make the right decisions. So I appreciate you guys taking the time to jump on the call today. And if you have any questions, please reach out to us. Thank you.